back to Legal Chunks, and today I want to do a quick video on liquidity. I've been getting a couple of questions about this topic, and I want to just dive into it. Liquidity is found and located at short-term highs and short-term lows, higher highs, higher lows, lower highs, and lower lows. Those are the key points that show us and give us liquidity areas. So what are those? This area here, short-term low before making that bullish push, another short-term low before going bullish, another short-term low before going bullish, another short-term low before going bullish, another short-term low. Those are liquidity areas. Now, likewise, this area here, short-term high for retracing, short-term high before retracing, short-term high, short-term high, short-term low, short-term low, short-term low, short-term low, short-term high, short-term high, short-term high, short-term high, short-term low. So hopefully you were able to see that. I'm just pretty much finding areas where the market reversed and left wicks behind. So the ideally behind liquidity is that a short-term low will be a sell side area of liquidity. So let's actually draw this area here. Short-term low, sell side area of liquidity. Now the idea is that when price punches down through this area of liquidity, that is taking out orders. There are sell stop orders beneath this area, meaning that some people expect when a short-term low is taken out, they are expecting the market to continue to go bearish in this fashion, or at least to the next level. So with liquidity, understanding how to trade off liquidity, it lets us see that when the market actually punched through this level, there's going to be something that happens on a smaller time frame that actually lets us know that it's going to reverse and go bullish. In turn, activating those sell stop orders and pushing the market bullish. So it's going to activate those sell stop trades and then push the market bullish and take those people out of those limit sell stops. And it's going to go bullish and be a stop loss. So activate, then hit stops. Now on the flip side, we have buy side liquidity. So buy side liquidity, let's look here at the good area. The market hits this buy side, punches through, activates the buy stops. And once it activates the buy stop, reverses, hits the stop losses of those buy stop orders and continues to go bearish. Then what you see is that the market comes here, right to sell side again, activates those orders, sell stops, reverses, then goes bullish. Now, the market likes to move in structure, but it likes to move from liquidity area to liquidity area, from the liquidity area, liquidity pools. So we like to target liquidity areas when we enter trades, and we can look at these areas for entries as well. So I'm going to drop down to a smaller time frame and show you how you could capitalize on these trades and these setups. So we're on a 1 hour chart, and we can see that the market came and punched up through this area of liquidity. Also notice this. It doesn't change anything because on a different time frame, this would have been a sell side area of liquidity as well. Notice how the market came, punched through here, begin to push up, punch through here, begins to push down. Retracement comes down, punches through here, begins to push up. So liquidity, you can see here again, punches through here, then pushes up. The market likes to seek out the liquidity before going in the opposite area. So when you come here, this is at 4 p.m., we're going to look at the price action on the 1 minute time frame. So on this 1 minute time frame, the same way I entered a lot of trades, what we can see is that we had a higher low structure that was broken. So what you're going to look for is that higher low structures are broken or a market shift. So it doesn't have to be a structure, it can be a shift as well, which I will show you in the next example. So in this strong push down, when it broke the structure, now we're thinking, hey, market broke structure, we want to go bearish. Now we're looking to get in bearish off of this area missing price or this fair value gap. Notice how this wick, strong candle, this candle leaves the wick to the top. This wick to this wick creates that fair value gap. We draw it outside. Now what we can do here, I like to take entries that are 23 points, pretty much standard for me. And you can take this as a 2-to-1 trade or a 3-to-1 trade based off how I trade the fair value gap of a liquidity area. Now we can look and see that this obviously was a great trade. Now, what you also can do is target the next liquidity pool. Once this area was broken, we can go back to the 1 hour chart. So once that trade, we hit profit in that trade, then we know we go stops to break even. We could have been actually targeted liquidity areas, this area of liquidity or this area of liquidity. So this could have actually been a 3R trade or 5R trade. And if we target this sell side area, this is a 6R trade. And if you held all the way down to the sell side, which would be 4-hour liquidity to 4-hour liquidity, if you was to hold it, look from this area to this area, you would have had a 14-hour trade. Just showing you the power of it, not saying it's going to happen all the time, but that's just the power of it. So coming into today, we see the market was at that 4-hour level of liquidity that we draw on a higher time frame. The sell side area liquidity. Now, sell stops and buy stops, for anyone who's confused why I keep saying sell stops and buy stops, here's a chart, a diagram for you to look at. So I always talk about limit order traders on this channel. So a limit order trader is someone who will use a limit, meaning when the market comes to your limit order, it's going to reverse and go in the opposite direction. So when we get a retracement, say we're going bullish on the charts, and you get that retracement, your limit order is going to be acting as your entry before the market reverses and goes and continues in the direction you desire. Now, a buy stop means if this was the area that you put your stop, once the market breaks past it, it's just going to enter you into the trade. Okay, so buy stops, once you break past this area, you're in a trade. Sell stops, once the market breaks past this area, you're in a trade. Sell limit, once the market gets to this area, you're in a trade. Buy limit, once the market hits this area, you're in a trade. But the buy limit is going to actually hit the area reverse. Sell limit hit the area in reverse for the sell. Buy stop is actually going to hit the area and continue, right? So it's different areas, to ways to get into the market. Not trying to be confusing, but hopefully this diagram helps you understand liquidity more. Now, coming into today, the 15-minute chart, what we see is that, okay, we were in this area, boom, boom, boom. Now, I want you to understand liquidity. I'm going to continue to show you examples of liquidity. Liquidity here is buy side liquidity on the 15-minute chart, regardless of if it reverses price completely or not, it still is liquidity. As we can even see here, sell side liquidity reverses price, boom, boom, boom. So looking at Wednesday, what we can actually do is go down to that 1-minute time frame. What we can see is that we are underneath this liquidity. So this liquidity area is here. Once the market starts to dig down in this liquidity, we're waiting for a structural or a market shift. Market structure switch will come here because this is the lower high to lower low. So if the market actually breaks this level, this would have been the area that I'm looking for, just like on my other setups before I go bullish. Now, this area here was a short-term high. Once this short-term high is broken, it's not a lower high, this is a short-term high. Once this is broken, I actually can begin to look for trades that are bullish. Now, it can be a little difficult to call on this situation because once it breaks, it's not back inside of the actual liquidity. So the liquidity is here, we're still beneath the liquidity. But once this market here, strong bullish push, actually happens, it does break this lower high market structure, and you can actually come here. You see there is an area of missing price, and from here you can take your entry. Like I got my standard entry from NAS here, and you can see that this market actually flew. And you can target that 3R like I always do, 2R or 3R, or that liquidity to the buy side, which is the liquidity that we have found on the 15-minute chart. If you was to continue to watch this trade, it actually just super flew. And when you want to say, well, where did it fly to? Well, let's go back to the 4-hour chart. Hits this liquidity area. I want to target this one and this one next. So this area here would have been about an 8R trade, 7R trade, and to the extreme high would be another 13R trade. Now, currently we're here in price, but I want everybody to understand when you combine this with structure principles and concepts that I've used on this channel, it's mind blowing. So this is just my introductory liquidity video. I will get more into detail, but I wanted to just introduce a couple concepts to you all, and hopefully you can see these on the charts now. I am Legal Chunks. Like, comment, share, and subscribe. Thank you.